The portfolio has changed from last year, mainly through our reduction in credit. So we have had this credit focus on the fund for all of last year, and on the belief that that's where most of our returns would come from. So we've cut some of our high yield exposure. We've cut a little bit of our investment grade exposure as well. And we've increased our government bond exposure. So government bond exposure over the past few years has been practically non-existent on the fund. As yields have been rising in the past year, we've increased particularly our short-dated treasuries. So we've gone from nearly zero weight to almost 20% in that part of the curve. The overall credit quality of the fund has also improved. So we have an average rating of BBB now, when we were a BB. So the fund has shifted slowly as yields have been rising. We've been shifting into short-dated assets. So which assets are more attractive, government bonds or credit? Like I said, we're now in a raising yield environment. Credit spreads are fairly valued, some would say somewhat tight in some parts of the fixed income spectrum. So that makes it a little bit of a challenging situation for fixed income investors. So one thing that we have to monitor going forward is how much are interest rates priced into to government bond markets, and also inflation expectations. So that's yet to be determined in terms of where we're heading in terms of global inflation. There's still little evidence, yet the market is starting to price in inflation expectations moving up. So it's going to be a challenging time for both parts of the markets, both corporate and government bonds. So it's going to be a year of playing relative value within those segments. So at the moment, like I said, we're taking on this barbell approach, which is increasing short-dated governments as yields rise, and doing a little bit more with relative value within corporate credit, as spreads are also expected to rise a little bit. In terms of attractive sectors, across the board, we're really looking at sectors that offer positive free cash flows right now, especially in cyclical sectors. The cycle right now is showing kind of end of cycle tendencies. Yet we believe that there is still global growth and growth in the economy to sustain corporates that still have strong free cash flows. And we find some of those companies in the energy sector, and we still like financials as well. Our outlook for interest rates in the United States and Europe in the next coming months. For the U.S., we're expecting at least 3 more rate hikes for the rest of the year. The market is pricing now a little bit more than that, so there's more expectations that interest rates will rise a little bit further. In Europe, we're still focused on the reduction in QE, and expectations are for interest rates only to rise in the second quarter of next year, so we're still ways away. However, the differential between interest rates in Europe and the US are at the highest for a long time, if not on record. So therefore, and they're somewhat correlated. So we think there'll be some kind of tandem movement as well.